Okay, folks, welcome to the Contrarian Trader. This is Robert Desmond. Let's begin by making a statement, and I'm doing this on April 2nd, about 10 o'clock at night as I'm reviewing my charts, doing videos. I strongly suggest that if you are long, you seriously consider trimming back your long positions and think about adding to shorts. And let's go through a few charts to just show you what I'm looking at. What you're looking at here is a 2-hour chart of the IWM, the Russell 2000 ETF. And you can see that we were range bound. And this period here, 2-hour period here, was at the close on Friday last. And you could see that in that last 2-hour period, money just came in as we hit the upper band. As a matter of fact, we didn't even hit it. We came near it, didn't even have the strength to touch the top of the band. Smart money just came in and sold into the rally. And that rally continued until Monday. They bid the market up. I always tell my members, beware the bright green futures. They bid the market up on Tuesday morning, got all the crazy money, the amateur money excited, got them to chase stocks higher, and what did they do? They sold right into them, and although the Dow Jones and the S&P 500 managed to close higher, the IWM diverged. I sent out an alert to members stating that they are going to try to defend the $93 per share level, and sure enough, on Monday they did that. I also warned them, watch out for $93 per share. If they close it below $93 per share, you're going to see a market correction. And what did they do? They bid it up on Tuesday, sold into it, and they closed it down below 93, and in fact below the trading range that we've seen over the past week and a half. Not good for the IWM. Let's take it a step further. Let's take a look at the daily chart. Okay, daily chart of the IWM. You can see that an incredible run since November. And what you didn't hear on CNBC, I listened to it. I was in the car today at the close. I was listening to it on Sirius XM radio. And all you heard were the Dow Jones Industrial Average and S&P 500 making new highs. Bob Pisani, Maria Bartiromo, chortling about how the market is just in bull rally mode. They didn't say a word about the IWM breaking down, diverging from the overall market, and not just a little bit. It broke down below the lower band of its rising uptrend channel, and it did so on incredibly high down volume, 2 days in a row. Slow stochastics rolling over, MACD rolling over. There is nothing about this chart that is appealing to me. RSI broke down below the lower band of the rising uptrend channel, confirming this down move. Stay away from the IWM, long anyway. Let's take it a step further. Let's take a look at the Dow Jones Industrial Average. Let's begin with the daily chart. Okay, here you have it. Overlaid here is money flow. Overlaid here in green is the US dollar. And you can see this blue line here is meant to show where the relationship between the US stock market and the US dollar changed. And I've been studying this for several weeks now because I found it odd that since 2002 you've had the US dollar trade inversely of the US stock market. That all changed here. The US dollar has been rallying with the US stock market. Oddly enough, though, when you take a look at money flow on a daily chart, it's in a downtrend. The inflows of money is slowing up dramatically into the Dow Jones, the large caps, yet the stock market keeps rallying higher. That's telling me that the smart money that's been in this market for the past several years, they are slowly taking their money out, going to cash, putting a bid underneath the US dollar, and they're sitting in cash. You have money managers chasing yield that continue to bid the Dow Jones Industrial Average up, the S&P 500 up on ever declining up volume. The other thing today, again, this is a daily chart. The other thing today that CNBC failed to mention was that there was a divergence. There's something out there called the Dow theory. If the Dow Jones is making new highs, you want to see your Dow Transports confirm that move higher. There's only one problem. This is a chart of the Dow Jones Transports, and it's mirroring the breakdown in the Russell 2000. So the Dow Jones is rallying, and the transports are breaking down. As a matter of fact, after this a magnificent run from the November lows, we actually put in a lower high. This breakdown here, if we make a new sequential daily low, that's a short signal. Put your shorts on, be short of the transports. Take a look at this volume. Massive, massive distribution. Let's take it another step further. Let's take a look at your Dow Jones Industrial Average on a monthly basis. Here's the same money flow indicator I put up on the daily chart. Now you saw the divergence of money flows slowing down, dropping off on a daily chart. What makes it even more scary is that if you take a look at it on a monthly chart, you had a double top setup back in mid-2011. And ever since that point in time, we have been in a downtrend. Take a look at I annotated these downtrend lines. We can't get above this declining downtrend line. The question you need to ask is, how long is this sustainable? Now, if the money flows were to break out above this declining downtrend line, then I would say, okay, I need to rethink my theory. But as of right now, you're seeing money flows leave the U.S. stock market, yet the stock market continues higher. What else is going to cause a problem? What's going to be the catalyst for a sell-off? Well, I think technically we're already there. But let's take it a step further. Let's take a look at the currencies. You have the S&P 500, which continues to pound its way higher, which is reliant 50% or more in some cases, company by company, sector by sector, reliant on foreign sales for their earnings growth. Now, year-over-year earnings are dropping off. Add to that, you have a euro that is declining, that's making European goods cheaper overseas. They need to have a declining Europe to get out of recession, which they are mired in. You have the Japanese. This is the yen on a weekly chart. The Japanese they pretty much come out, so they're devaluing. They are pumping more liquidity into the system, and that's going to make their goods cheaper. This weekly chart here, what you're seeing is a little bit of strength. This is an oversold bounce. Here's your downtrend line. My guess is that we've seen the top on the yen. You have your 50-period moving average starting to take out the 200-period moving average. That is going to be a bearish event. My guess is we're going to take out 101.57. The yen heads lower. The euro is going to head lower. The US dollar, what's it doing? Weekly chart, it's breaking out. It retested the upper band of the pennant formation that it has been in for 3 years now. It's broken out. It's tested that support, previous resistance, and it looks poised to rally. What does that do? What's my point? My point is that in an environment where you have earnings that are decelerating, you have a market that has multiple expansion right now. People are willing to pay more for a dollar's earnings. And you have the US dollar, which is strengthening, which is going to have an adverse impact on the bottom lines of the multinationals, which continue to rally. That does not bode well, especially when you take a look at last week, the March 26th consumer confidence. Big miss. Market expectation 66.9. Actual 59.7. Fast forward to this week. April 1st, you had ISM index came out. Market expectation 54. Actual 51.3. ISM is a manufacturing index. A number below 50 is a sign of contraction. This in and of itself is not a reason to sell the market. Now, it would be disingenuous of me to say that we haven't seen good economic data over the course of the past couple of months. The problem is that we've seen it sporadically ever since 2008. What we have yet to see is consistent growth. And I'll point out to you that despite all the good news that's come out over the past couple of months, you still had a fourth quarter GDP, the best that they could come out with all of this liquidity, is 0.4% growth in the fourth quarter of 2012. Not 4%, 0.4%, and that's with the Federal Reserve buying $85 billion per month in Treasury notes. This is not good. Am I dumping all my shares that are long? No, I'm dumping those that are extended, and I'm adding to shorts. Folks, if you're not currently a member of the Contrarian Trader, check us out. We're ahead of this move lower. This market is going to head lower. I'm not going to say tomorrow it's going to collapse. We are heading lower. The small caps are already breaking down. The transports are already breaking down. It's only a matter of time with the money flows declining, volume up to the upside dropping off. The Dow Jones, S&P 500, they're going to begin to buckle. So please use caution. Start building up your cash positions. If you have any questions, please shoot me an email. Talk to you soon. Bye-bye.